You could look at some of those charts, particularly anything in retail sales, and say, that's a V-shaped recovery. I don't need more stimulus.
Well, I think you got to look at a couple things. First, people are able to buy things either online or from stores, and they have the wherewithal to do that, and they're going out and buying. But I do think that when we think about where the jobs are in the economy, it's still in the services sector that still is very, very weak. In bars and restaurants, we're down in terms of the data. So we still have a very, very unbalanced recovery for the United States, and actually this is true for around the world. And until we get more balance in here, we really can't say that we're out of the woods, because balance is really important when we think about prospects for sustained growth going forward.
Let's talk about that sustained growth and the kind of growth that we're going to have, Catherine. I want to take you to Boston. Mr. Rosengren from the Fed speaking right now, talking about policy support, setting the economy up for a much stronger second half. How much stronger?
Well, I think the U.S. economy really is, if the fiscal policies come through anywhere near the size that we're talking about, the second half of the year is really going to be dramatic for the United States. But United States is still only part of the global economy, and especially to the extent that we see a lot of spending in the form of goods as opposed to services, there's a lot of spillover to the global economy through the trade channel. And so I think we're going to be surprised when we see some of the trade data coming in, and it's going to make the trade deficit look larger for the U.S., and that's going to be a negative when we look at some of the GDP numbers going on in the second half.
So are we justified at yields at 1.28, 1.33 on the 10-year?
Well, they've been, somewhat subdued for an extended period of time, and to expect some increase coming from both the demand side, the real side underpinnings of the economy, that makes sense. The inflation, there is going to be more inflation this year than there was last year. Nothing that's out of the ordinary, nothing that's should be a scary inflation. We're not seeing anything even above 2% sustained for the year. So, the other factor, I think, that on the 10-year that we have to remember is there's a lot of foreign demand for U.S. securities, and the more the 10-year looks attractive, the more those foreigners want to buy it. And so that is a sort of a natural cap on how high the 10-year can go.
OK, let's fold this in again. Back to Rosengren. He's speaking now. Inflation is still too low, he says. Do you think the Fed, though, may end up getting pushed around by the market? If we get up to 1.5, if this move in yields continues sort of upwards from there, is that going to force the Fed's hand?
So I think we have to question, what exactly is the Fed trying to do? I mean, it has its dual mandate, the average inflation objective now, and as well as a broad-based and inclusive objective with regards to employment. We're a long way from reaching that second objective for sure. On the first objective, we don't have sustained inflation that would achieve some sort of average inflation targeting. So the question is, what exactly in the markets would represent the type of turbulence or pushback that the Fed has to address? Are we talking about that 10% correction in the U.S. equity markets that my colleague Tobias Lefkowitz was talking about on Bloomberg earlier this morning, having written about it last night? Is that 10%? I don't think that's really much of a challenge for the Fed, given how far the markets have already incorporated multiple times good news. The interest rate concerns, as again, I think there's some moderation in the pressures on the interest rates coming from foreigners purchasing U.S. assets. And I think that that's a factor that really has been an important moderator of the market. And so it's the market, the foreigners, doing some of the work that some of the domestic people think that the Fed ought to be engaging on. So I think we have to think about this in terms of a global context, especially when we think about market moves on the U.S. Treasuries.
Question on the relationship between all of this. Is it binary? As in, like, if we get a really big stimulus, will inflation completely take off or not go anywhere? Does it have to be a binary situation that everyone is talking about?
No. I think what we really ought to be thinking about, especially if you're an investor, is thinking about granular. In other words, there are definitely going to be some sectors of the economies around the world, not just the U.S., that are going to be able to pass through some of their cost increases and have traction, have pricing power, and gain more in terms of maintaining their earnings because they're able to pass through cost increases. There are other sectors where this is not going to be the case. And so if you're thinking about inflation, you really have to get down below the top line in order to take advantage of these differentials across the different sectors. And once you think about that granularity, it starts to erode any notion that there's a sustained increase in inflation, broad-based top line across all sectors, because there's so much cross currents that's happening under the.
Catherine,
yeah.
To me, something that really stood out over the last 72 hours is that we're going to have a real energy supply, infrastructure, battery storage conversation. And I wonder how you think about that conversation as it relates to stimulus, as it relates to D.C. and a green plan.
So we've been talking a lot about these two roles for fiscal policy now in the U.S. economy, and again, this is a conversation that many countries are having. The first phase of all of the fiscal efforts associated with COVID was about life preservers. In other words, maintaining people's incomes, maintaining businesses through the pandemic, so that there would be both spending power as well as businesses who spend it at the end of the pandemic. But it was always the case that at some point there had to be a pivot from life preservers to an infrastructure, green-related fiscal strategy. The green-related strategy, the infrastructure-related strategy would catalyze private sector investment, and that's the foundation for sustained growth going forward. Life preservers are good, they're necessary, they were required, but you've got to have this pivot to these longer-term sustainable underpinnings of growth. Green is one of them. Infrastructure is part of that. Different countries are moving forward to different degrees in that regard. In the U.S., there's a concern that how many times is the administration going to be able to go back to the well? That's the real concern.
Yeah, I think that's a really key point, Catherine. Would it be better to make that pivot now? The president's talking about going big. The current program is going to drive consumption. It's not going to drive investment. Should we be making that pivot earlier?
Well, it would make sense to incorporate both the objectives of enhancing job capabilities for people, income growth for individuals, as well as having a more green-oriented agenda. I mean, one strategy, of course, where you can combine these two is, of course, in mitigation and adaptation of many, many buildings that still need to have a much more green-oriented, whether it be windows, roofs, walls, et cetera. It's a very, very, it's a strategy that is growth-enabling, it's job-creating, and it's also green. So thinking about that combination is something where it's really getting, two gains at once.
I feel like we get bogged down a lot in the short-term differential between, say, Europe and the U.S. when it comes to vaccinations and the variants. And I wonder if the conversation in a year, is it going to be about the differential in the green plans and the stimulus money in relation to that? How does this play out for growth over the two continents?
Well, sort of, the Euro area had the Next Generation EU, sometimes it's called the Recovery and Resilience Fund, and that was always designed when it was originally put forward late last year, it was going to have money go out in 2022, and that is when the money's going to go out. There's a lot of reform associated with that as well. So when that was originally promulgated in Europe, it was very, very positively received by the market. It was not just that it was going to be green, that it was going to be money, but of course it was pan-European, was going to be funded by pan-European financial assets. So that looked really good. Now, of course, Europe gets bogged down in details a lot in terms of actually getting these things done. But I think what we're going to be looking at in 2022 is a very different pace of economic activity between the U.S. and Europe. And, we'll have to see then how much this green agenda really has greater footing in Europe than it does in the U.S.
Catherine, you're already beginning to see the market pricing this in, less so in the currency market, but you need to have, you've got competing trade and financial flows there, which I think is something the market's still trying to figure out. But if you look at break-evens, the difference, we're at record wides between Germany and the United States at this point. How big a growth differential are we going to see?
Well, when we look at growth differentials in a couple of different ways, most recently in the Global Economic Outlook and Strategy report that we issued last month, we started looking at standard deviation from historical experience as a way of thinking about growth differentials instead of just looking at the raw data or the raw projections on sort of GDP growth. And we're looking at the Europeans in 2022 having a standard deviation growth differential, whereas the U.S. is close to zero. So at this point, when we think about those way of thinking about growth differentials, it's a pretty big gap between where the U.S. is likely to be in 2022 and where Europe is, much favoring to Europe.
Does that lead to any central bank differentials?
You know, this isn't a question because between now and then, according to the sort of the models that we have on the fiscal impetus that's currently in the market and so forth, and on projections, we still have inflation rates really very moderate for both economies, and so there are going to be some interesting questions about where energy prices and commodity prices might pass through relatively more in Europe than in the United States because of the tax structures being different, but also how much firms have pricing power. Once again, I talked about that in the last segment. I think it's a very important question, whether or not firms might have more pricing power in Europe than they do in the United States. That's going to make for an inflation differential as well.